Wouldn't it be great if you could sell a stock at a gain and not have to pay any taxes on the sale of that asset? Most investors don't realize this, but there are ways to sell an appreciated security and not have to pay capital gains tax on the disposition of that asset. It requires prudent planning and a sound investment strategy, but it's certainly possible. My name is Ryan Knoll. I'm a financial planner and founder of NAV Wealth Partners, a financial planning firm that helps clients nationwide make smart tax decisions with their money. I advise many individuals who are compensated with company stock as a portion of their total compensation package. I also work with many well-compensated individuals who do a great job of maintaining investments in a taxable brokerage account outside of their workplace accounts. In both of these cases, these clients are likely in the 20% capital gains tax bracket, as well as the 3.8% net investment income tax bracket, for a total tax of 23.8% on any capital gain that they were to realize during the course of the year. So a client who has $100,000 in realized capital gains is going to pay the IRS an additional $24,000 approximately in tax, assuming they have no other transactions during the course of the year and an adjusted gross income over $600,000 and are filing taxes jointly with a spouse in 2025. This assumes that they don't do anything else and take no actions to mitigate the capital gains tax burden. If only there was a way that this couple could lower their tax bill. And this is where direct indexing comes into play as a portion of your portfolio's assets. Direct indexing is an investment strategy where you buy individual stocks in an index rather than purchasing an index fund or ETF directly. This gives you more control, tax efficiency, and customization over your portfolio. How it works is you try to, one, replicate an index. So instead of buying an S&P 500 ETF like SPY or VOO, you own the actual stocks within the index. So you're going to own a basket of approximately 500 stocks to simulate that underlying investment that you want to make in VOO or SPY or the S&P 500 overall. The second step is we're going to practice tax loss harvesting. If some stocks go down, you can sell them at a loss to reduce your taxes while keeping your overall index exposure. The third step is customization. You can exclude companies you don't want, like for ESG purposes, or you can overweight stocks that you believe in, or we can exclude company stock if you, like, say, work for Meta and you want to exclude Meta from the S&P 500 direct indexing portfolio. You can leave that out of the portfolio so you don't have an even greater overconcentration of that one individual stock within your portfolio. So the benefits of direct indexing are tax efficiency. You can sell losing stocks while they're down to offset capital gains, or collect a $3,000 offset against your income for the current year. You have more control to customize your portfolio by adding and removing specific stocks, and you avoid fund fees. So unlike ETFs or mutual funds where you own the stocks directly, and you avoid the expense ratios that are inherent in those funds. So who should use this type of investment? One, high net worth investors who are looking to maximize tax benefits. A second set of people who can use that are people who want more control over their investments. And third, long-term investors looking for tax efficiency over the long run. The downsides of direct indexing is that it's a little bit more complex and it requires managing many different individual stock positions. It's not ideal for small investors. This works best with a large portfolio, typically $250,000 or more, where we can really spread out the assets over many different securities to help replicate the underlying index a little bit better than we would at a smaller balance. And it's also very time intensive if you do it manually, as opposed to using somebody like myself, a financial planner, who's a computer algorithm that automatically scrapes those losses at the end of every day. So that way you're realizing the maximum amount of loss possible while then getting those funds reinvested back into the portfolio in a different security to avoid the wash sale rule. Now, to help illustrate the point, I'm going to walk you through a basic example of a direct index versus an ETF investing approach. So let's assume that you want to buy an index fund or an ETF, and it's made up of 4 stocks, A, B, C, and D. And you invest $1 million in this fund, and each of the 4 stocks are equally weighted, making up 25% of the portfolio, or essentially you're investing $250,000 in each of these securities. Stock A is up 100% during the year, while stocks B, C, and D are all down 20%. Your fund would be up a total of 10% during the course of the year and would be worth $1.1 million. But those losses in B, C, and D, which total $150,000, cannot be harvested because they are inside of this fund wrapper. Now, if our investor would have followed a direct index approach, they would have bought these 4 stocks all separately for $250,000 each. Stock A would be worth $500,000 at the end of the year, and stocks B, C, and D would each be worth $200,000 or $600,000 total. So your account's still worth the same $1.1 million, but what we can do is we could sell the 3 stocks in the losing position, B, C, and D, and realize a loss of $150,000 that we can utilize to offset capital gains elsewhere within our portfolio, or take as a deduction up to $3,000 against current year's income. We could also at that point replace them with similar securities that we expect to perform well to keep the money invested and avoid creating a wash sale. So if we look at stock B, for example, let's assume it was something like Coca-Cola. We would replace Coca-Cola with Pepsi, which is a very similar company that should have correlated performance to the original holding, keeping you invested and having performance expectations being relatively in line with what they were had the original position been held. Now, before we go on to do a brief case study, I just want to remind you to hit that subscribe button at the bottom of the page. Also, feel free to throw this video a like if you like this type of content. This will help me know what to prioritize when making videos for you in the future. Alright, so now let's jump into the case study. I'm going to go through a real life conversation I had with clients who I onboarded towards the end of last year. The numbers are slightly adjusted, but the concept remains the same in this case study as it did for them back in October. These clients had a projected taxable income of $595,000. They made 401k contributions between the two of them totaling $30,000. The wife maxed hers out for 2024 with a $23,000 contribution, and the husband planned to make a $7,000 contribution into his 401k for the year. Their taxable income for the year up to that point was made up of $150,000 in taxable gains because they had sold some stock at a gain in order to purchase a house. So when I met with them last year, their major concern was how they could pay less in tax given their transactions for the year. If they made no changes, their capital gains would have been taxed at a 23.8% rate, and they would have been in the 35% marginal tax bracket at the federal level for 2024. So when looking at their situation, immediately they could reduce taxable income by $16,000 if the husband maxed out his 401k to the 2024 limit. This would reduce their taxable income to $579,000. And this did two things for them. First, it saved $5,600 in federal taxes by making the contribution. And next, it lowered them from the 20% capital gains tax bracket to the 15% capital gains tax bracket, which saved them an additional $7,500 in capital gains taxes. But after analyzing their portfolio a little bit more, they had roughly $10,000 in losses that they could net against their capital gains, which saved them an additional $500 in tax. So somewhere between a $13,000 and $14,000 tax savings by making an additional $16,000 contribution to the husband's 401k. Now, most of their portfolio as it stands today is in broad-based index funds, but after selling the securities at a loss, we were able to fund a direct indexing strategy moving forward with $100,000 initially, and they're adding $5,000 a month to that investment as well. This should give them the opportunity to realize more losses through the year and use those losses against the remaining gains in their portfolio, of which are about $250,000 as we stand here today. So now you understand why following a strategy that allows you to harvest losses more frequently can save you thousands in taxes annually. In this client's case, I was able to save them around $13,000 for last year and set them up with a strategy that will hopefully allow for lower capital gains realization moving forward. Now, direct indexing is a valuable tool when used appropriately. It shouldn't be your entire portfolio, but utilizing a portion of your funds for this type of strategy will allow you to have a more effective tax management over time. And if you're wondering how this strategy could potentially save you thousands of dollars in taxes, please feel free to follow the link below to schedule time on my calendar. We could talk about how this applies to you.